Hello, my friends. Today is March 15th, and this is Markets Weekly. So this week I'm on the road, so we'll be a little brief. Today, let's talk about three things. First, we have to talk about the price action the past week. It was a very volatile and exciting week in markets. Secondly, let's talk a little bit about the economic data, especially the inflation data we had the past week. And lastly, let's have an update on the ongoing trade war. So starting with price action. Well, first off, I'd like to direct you to my Markets Outlook 2025 I gave in December, where I gave a year-end target of 5,500 for the S&P 500, 3,000 gold, and 4% 10-year yield. Now, between now and then, it seems like everything has moved in the direction that I guided towards. So again, I'm fairly happy with that. And to be clear, nothing goes in a straight line. But starting with equities, the past week was a very volatile week in equities. We had big swings up and down the whole week, but on a week-over-week basis, price didn't really change that much. On Friday, we did finally get that huge vol cross we talked about last week, and that pushed the S&P 500 up 2%. Now, it does seem like the S&P 500 and the major equity indexes are becoming a little bit more stable. Again, it didn't continue to decline the last week. It does seem like we're finding some degree of support, but I think the trajectory of this is going to be in large part dependent upon headlines. Again, how the trade war progresses. But with volatility coming down, it does give me the sense that maybe there's less panic in the market. The market structure is a little bit more stable, and so doesn't seem like we'll get that much instability going forward. And of course, nothing goes in a straight line. I wouldn't be surprised if we did bounce for a few days or even a few weeks. Looking at the 10-year yield, we came down as low as, let's say, 4.2%, but did revert to 4.3% towards the end of the week. Now, heading into the year, the market was only pricing in one Fed cut. Again, I've been very vocal for the past few months that that's not reasonable. My base case continues to be 4 to 6 cuts this year. But today, the market is pricing in about 3 cuts. The market is taking note of the geopolitical risk, the tariff risk, and of course, the economic data has been surprising to the downside. So the market is pricing in a few more cuts. That seems reasonable for now, and we'll see, and we'll look at the data, which we'll talk about in the next section to see how that will continue. And the last thing that I'll take a note is gold. Gold surged to $3,000. And I'm not really sure if there was any discrete news driver. We've talked about gold before. Many people buy gold for different reasons. It could be due to monetary policy, it could be due to geopolitical risks, and it could even be due to tariffs, as people are worried that maybe gold will be tariffs and try to get their gold into the United States ASAP. So gold looks up, I'm not really sure why gold went to $3,000. But it seems like a lot of people like gold. It could be central banks continuing to diversify, but the trend continues to be higher. Nothing goes in a straight line, but I think there could be that someone knows something. Again, we have a lot of geopolitical risk brewing the background, so let's keep gold in mind and watch it closely in the coming weeks. All right, secondly, let's talk a little bit about the economic data. So this past week, we had CPI and PPI. Now, the market has been very focused on inflation for the past couple years and continue to be focused about inflation now. Now, CPI was pretty hot in January, but there was some thinking that maybe this was just some kind of seasonality effect. So last year, we had a very hot January print, followed by pretty moderate prints in February and March. The reason behind that is that a lot of times businesses raise prices in January just to raise prices for the year, and that makes January inflation look pretty high and gives the impression that inflation is out of control. Now, the economists are supposed to adjust for this with seasonal adjustments, but those adjustments aren't perfect. Now, CPI this year, hot in January, but the CPI we got last week for February was pretty cool. On a month-over-month basis, core CPI was only 0.2%. So it does seem like the hot January print was just seasonal effects. PPI was also a bit cooler than expected. Again, the Fed doesn't care about CPI or PCI. What they care about is PCE. Unfortunately, the components in the CPI and PPI that feed into PCE were not really cool. If you look at the Cleveland Fed's forecast, they're thinking that core PCE will be about 2.6% year over year. So, that's not super high. It's just a little bit above the Fed's target, but it does show that inflation progress, as per the PCE, has basically stalled. So, looking at inflation expectations, which the Fed has been talking about, we're getting some pretty crazy inflation expectation reads based on the latest surveys. Democrats are basically having a 6.5% inflation expectations for the near term, Republicans about 0.5%. So how you think about the tariff war is affecting how you think about inflation expectations, and it's getting really, really crazy for some parts of the population. Again, this is a reflection of how fragmented our political system is and of our media ecosystem as well. If you listen to some, left-leaning channels, they'll be telling you nonstop, trade war very bad, inflation out of control, and I think that's scaring some portion of the population. Now, the Fed in the past has communicated they focused more on longer-dated inflation expectations, and if you look at those are ticking up a little bit, but still pretty low, and Fed officials have described them as contained. So I'm not sure they're going to pay too much attention to these gyrations in short-term inflation expectations, although it does show that at least some portion now of the public is getting really panicked. Something also interesting in these in recent consumer surveys is job prospects on jobs, and this was flagged by Renaissance Macro, who also has a really good weekly podcast that I recommend. Now, Neil Dota over there, who is their chief economist, has flagged that consumers seem to be more and more downbeat on the job market. There's some nuance to this. Parker Rose, who also does very good economics, has another survey showing that if you are a white-collar worker, someone who's making higher income, your job prospects, your perception of your job prospects is declining. But if you are a blue-collar worker, someone who is making lower income, you're actually feeling pretty confident about your job prospects. So overall, it seems like a lot of people who are higher income are feeling pretty downbeat on the job market right now. And I think that's not surprising. We do see anecdotally, we see a lot of layoffs in big private sector companies, again, like the big tech companies. And if you're in the public sector, of course, Doge is continually telling you that they're going to cut jobs. So I can understand if white-collar workers feel a little bit more downbeat, and maybe that will feed into the economic data going forward. So far, though, looking at the jobless claims data and the NFP data, we don't see huge layoffs so far, but I think a lot of people expect to see that in the data in the coming months. All right, the last thing that we want to talk about is updates on the tariff war front. Now, one thing I would add before we go into that is that there seems to be a last-minute deal between Democrats and Republicans to avert a government shutdown, and so that takes away a little bit of the tariff risk that could have been weighing on the market. It does actually relate to monetary policy too as well. There was some thinking by Fed officials that if we did have a government shutdown, maybe they would end quantitative tightening soon, maybe as soon as this coming week. But with the shutdown averted, it looks like quantitative tightening can continue for a little bit more, maybe several more months. Now, on the tariff front, again, the big date is April 2nd, but this past week we did get big developments on steel and aluminum tariffs, where President Trump put on 25% tariffs on steel and aluminum imports. And this is something that Trump did during his first term as well, so it shouldn't surprise anyone. Now, the rationale for this is national security. The thinking is that if the U.S. ever were to fight a war, obviously they need to be able to produce their own steel and aluminum, so these industries must be protected. Now, when you say national security here, basically it's kind of a carte blanche, so I think that there's not too much opposition to this. Now, curiously though, you don't actually hear a lot of opposition from Democrats about the tariffs on autos and so forth either. I think right now a big part of that is that the Democratic Party really wants to win back the Rust Belt voters, and it seems like a lot of the manufacturing blue-collar voters in the Rust Belt really do support these tariffs. A very interesting letter from the United Auto Workers not too long ago. Actually, they had an official statement in support of these tariffs, and noting that they think that NAFTA, the North America Free Trade Agreement, was a big contributor to the demise of the U.S. manufacturing sector. So if you are an opposition party and you want to win back the Rust Belt voters, it's a very difficult line to walk, and they don't seem to be voicing too much opposition to these heavy industry tariffs. So that seems to be going through. Now, if you look at the data, these steel and aluminum tariffs are going to impact Canada the most because as far as steel and aluminum imports, most of them come, well, a large portion of them come from Canada. Now, when I listen to the earnings calls of the steel and aluminum companies in the U.S., they're all very happy with this, obviously, and they point to the fact that the premium of domestically produced, so the difference between domestically produced steel and aluminum and imported is widening. So that seems to be helping their industry. Now, very, very bad news for Canada, of course, which is in an ongoing trade war right now on many fronts. Now, in response to the steel and aluminum tariffs, we did see the European Union impose retaliatory tariffs on the US and Canada as well. Now, these countries are taking a very different direction from other countries. Now, Australia and Brazil, faced with these tariffs, decided to not impose any retaliatory tariffs and said that they're just going to negotiate. They're basically following President of Mexico, Claudia Sheinbaum's approach, not being escalatory, just taking the tariffs and saying that they're going to work with the administration, trying to get a bigger deal after April. And this has been very successful for Mexico. Now, it could be because Claudia is in a very different political position. She already won her election. Now she has to be a good steward of the Mexican economy in order to win re-election if she decides to seek it. In contrast, looking at, say, Canada, they're right now in their political cycle about to have an election in the coming months. Now, this tariff war has been bad for their economy, but very, very good for the political fortunes of the Liberal Party over there. The Liberal Party, which is the party of Justin Trudeau, and today Prime Minister Mark Carney over there, they have been doing very poorly in the polls, but this trade war has really revived their political prospects. It seems like there's a very big rally around the flag movement in Canada, and who knows, maybe the Liberal Party will actually stay in power in the coming, at the next election. So it seems like it's in their interest to have this trade war, and so they're very much escalating this. Now, this past week, there's a story in Bloomberg where it seems like Mark Carney is even hinting that maybe they won't be buying F-35s from the United States because of the trade war. Now, this is going to have severe downsides on the Canadian economy because Canada is a lot more reliant upon the U.S. than vice versa, but it could be a good political move for them. This past week, we also had the Bank of Canada cut rates to support the economy, and maybe they will continue to cut rates. So going forward, again, the steel aluminum thing, that doesn't seem like it's going to change. It seems like the Democrats are okay with this, so this is going to be something that sticks. The big tariffs, the reciprocal tariffs, coming on April 2nd, and we'll see what happens over there. Now, again, as more and more countries become more, follow the Claudia Sheinbaum motto of being non-confrontational, I think that takes away a lot of the downside that could happen. That could happen to the stock market and the economy. But again, we're going to see what the other actors do. Canada and the EU so far not on the same train, and they're a big part of the global economy. All right, so that's all prepared for today. This coming week is an FOMC week, so I'll be back to talk about what happened on the FOMC. So guys, I'll talk to you all then.